Welcome to FX Options University, recorded live at the International Securities Exchange, the world's largest equity options exchange. Join the industry's top trading professionals as they provide insight and strategies for trading in the currency markets using FX options. FX options are a low-risk alternative to hedging currency moves in any market condition.
So without further ado, I'd just like to give you a couple quick announcements that options do involve risk and they're not suitable for everyone. Please read a copy of the characteristics and risks of standardized options, and that is available from the ISC website or TradeKing.com/ODD. And this strategy that we're going to discuss involves multiple legs, meaning that there are multiple strikes involved, and so those involve additional risks, commissions, and potentially complex tax treatment. So just make sure that you're informed before trading. Okay. Just to be clear here, do you all see the slides changing now?
Yep, they're saying they do.
Okay, great, great. Let me just adjust this window here. Okay. If you're interested in learning more about TradeKing, we have a deep trader network at community.tradeking.com, as well as you can follow us on Twitter, Facebook. We have a great number of videos on YouTube, and we also have company updates on LinkedIn. And when you're not tuned in to the ISC webinars on Tuesdays, you can join us at TradeKing. They are also on Tuesdays at 5 p.m. and free and open to everyone, whether or not you have a TradeKing account. So please join us there. We have a varied list of guest speakers as well as in-house speakers talking about all different topics, from options, stocks, and different types of analyses that you can do, how to use our site better, you know, just to get proficient, orientations, and so on. So please join us. Love to have you there. All right, so today I'm going to speak a little bit about the euro, the EUI, and give you a trade example. This is the euro, US dollar euro. Why don't we just get started here? And as John mentioned, the archive is available on Condors. Don't worry, you don't need to have seen that in order to learn anything today, but looking at the two in context will definitely help your understanding. All right, so to briefly review, let's talk a little bit about what a condor is with the first slide. And just so you know, if you are interested in getting a copy of today's slides, it also includes the slides from last time. So you will get both sets at once. And if you'd like a copy, please send an email to webinars@tradeking.com, and something will be sent out to you tomorrow. You'll get a PDF of the slides. So that's webinars@tradeking.com. And if there's any questions that we don't get to today, you can feel free to email me at that address. All right, so what is a condor? Well, last time we said basically it's two spreads, and we talked specifically about the iron condor, which involves a short call spread and a short put spread. They're centered around the at-the-money strike, and typically you're using a time frame anywhere from, say, 30 to 60 days to expiration. And the takeaway at the end of that long discussion was we came up with a list of suggested criteria for this strategy. What are the items that you need to be aware of, and what the figures are, or the suggestions to go with for the condor itself. Now, this time, though, we're going to talk about the butterfly. So I'm going to skip ahead, and we're going to talk about butterflies and how they're different. So the similarities here are that it's two spreads. It's a call spread and a put spread in the case that we're going to go over for an iron butterfly. And whenever you hear the term iron, all that means is it's a combination of calls and puts together. If you don't use the term iron, then you're either talking about a call butterfly or a put butterfly, and that means you're just using all calls or all puts. And for the style that I'm talking about, this is quite vanilla, and that means that the at-the-money strike, excuse me, the short strike, the strike that you are selling, is close to the at-the-money, meaning that the underlying value is in close amount to the strike that you're short, the at-the-money strike. All right. Oh, excuse me, it's skipping ahead here. Let me just back up a moment. There we go. All right, so one's a long spread, one's a short spread, and all the options are within the same expiration month. If I was going to trade 5 butterflies, then the quantity would be to buy 5 options, sell 10 options, and buy 5 more options. Okay, so that's the ratio is 1 to 2 to 1, and that would be 5 butterflies. As I mentioned, there's 3 varieties, call, put, and iron, but we're not going to get into the advanced items such as skip strike, Christmas, and so on. We're just going to talk about the straight and forward butterfly. As I already mentioned, this is a multi-leg trade, so be aware of that, and this will generate several commissions. So just keep that in mind. All right, so let's continue. And this is an option chain from TradeKing.com. And as you can see here, let me bring up the pointer. This is on EUI, and when I took this screenshot, it was trading around 75.56. And what I did was I checked off the strikes that I wanted to trade. I put a B next to the 71.50 puts. I checked off twice to give me a sell of the 75.50 puts as well as the 75.50 calls, and then I also checked a B for the 79.50 calls. What this allows me to do is to trade right from the screen just by using this drop-down field here and clicking on trade a butterfly. So, but I can also, not only can I trade from this page, I can get a quote on that strategy, so I don't have to do it in my head if I don't want to. And I can also import this strategy directly into our P&L calculator, and that allows me to model the strategy and affect the various variables, such as implied volatility, time to expiration, as well as underlying value. This butterfly, so that for those keeping score at home, is $4 wide between the strikes, and I would collect a credit of approximately $1 on each side, so $1 on the call side, $1 on the put side, and that comes out to a $2 credit for a $4 butterfly. And we're going to get into a little more of that kind of detail in just a moment. Now here's today's example, and we're going to use fictitious symbol XYZ. And to give you the background on this proposed trade, the underlying instrument was at 734 or 732, somewhere between those values, approximately 51 days to expiration. All right? And what I've done is I've highlighted the strikes that I would use for this trade with the B and F notating buy and sell. And I've circled the at-the-money strike of 730, and that's where we are going to sell 2 options. All right, so here's a recap of the different strikes and how they will be used, and we're going to focus on the iron butterfly. So what this first setup looks like is we're buying 10 of the 650 puts, selling 10 of the 730 puts, selling 10 of the 730 calls, right? So that those 2 items together are the straddle. We're selling 10 of the 730 straddles, all in June, and buying 10 of the 810 calls. So you've got a lot of strikes here, right? 4 different strikes. And sometimes when you're trading a complex trade, you might lose sight of what the goal is of the strategy. You know, what are you trying to accomplish here? And I'm going to boil that down for you, and that's what we call the sweet spot at TradeKing. That's the profit area. Okay, so what do you want to happen? Where do you want the underlying to move? What's going on? Well, what we want here is we want minimal movement in the underlying. Okay, when I say the underlying, I'm talking about whatever the option is based on. So if you're trading equity options, it's based on stock. If you're trading FX options, that's based on that spot value that they provide, such as that 75.56 they gave you for the EUI earlier. You're talking about an index. You're talking about the value. Okay, so that's what the underlying is. And you want the underlying to have minimal movement. You don't want it to be fluctuating a lot. And so, you know, you want this to be a fairly quiet time. You don't want a lot of news coming out. You don't want a lot of economic unrest or geopolitical problems if you're trading FX options. You want it to be fairly quiet. So that's what you want to happen, because that will help the underlying to stay close to home. What do I mean by home? By the at-the-money strikes when you started the trade. In this case, that was the 730 strike. So the underlying was at 734. We wanted to stay close to 730. As you approach expiration, though, you really want, ideally, yes, you want it as close to 730 as possible, because that's going to give you the maximum gain. But realistically, you want it between the break-even points. And we'll get into that with some diagrams. Now, as you move outside of the break-even points, that's where you start to approach losses. So as you move from the break-even point to the max loss, which is the long strikes of 650 and 810, right? You can only have one event occur at a time. So if it moves all the way down to 650 or all the way up to 810, you will hit the max loss for that trade. As it goes closer to those points, you will start to lose more and more and more in that trade. All right, and here are your calculations for the break-even. All right, so let's get into a little more detail here. As I mentioned, you want the underlying to remain near the short strike. And another way we say that is we want the at-the-monies to remain at the monies. I don't want my at-the-money strike to become an in-the-money strike or an out-of-the-money strike. Okay, I don't want things to get moved around. I want it to stay close to home around 730. And the other thing is that because we are short two at-the-money options, okay, we are taking on a lot of risk that just gets magnified the closer we get to expiration. And some people will call that gamma week, okay, because the options have the ability to change in value drastically the closer you get to expiration. So because of that concern, and because you are short options, right, and when you are short options, you cannot control what happens to those options, right? I mean, we can't control anything that happens in the market. But what I'm saying here is that if you own an option, well, you have those rights to exercise if you choose, correct? Right? So if you have that right, you control that right. You may not use it. You may use it. Depends on the situation. But if you are short the option, you have given control up to the buyer, okay? And when you don't control the option, you don't know if you're going to get assigned or not, depending on whether or not the owner exercises. And when you go through expiration with that concern, you may not know where you stand come Monday morning, and you could have a lot of overnight risk when you're talking about equity options because you're dealing in shares. Okay? So just keep that in mind. So to manage the gamma risk during gamma week, during expiration, as well as managing the pin risk it's really beneficial for you to look to close out this trade well before expiration. All right, so what is optimal? I've already indicated some of it in that we want it to be fairly quiet, right? So we want a lack of news. We don't want a lot of things coming out of the news cycle. If you're trading this on an equity, you don't want earnings to be coming out. You don't want it to be surrounding a big economic announcement that the market is waiting with bated breath. You know, you want to wait till all those mover and shaker events have passed, if at all possible. It's not ideal for a trending market. If we're in a trending market, or the security you're looking to trade, or the sector and so on is trending, this is not the strategy you want to use in the way that it is designed here. There are other ways to vary a butterfly trade. I actually go into some of those variations in another presentation at TradeKing.com called The Versatility of Butterflies. And that you can reach our archives at http://tradeking.webex.com. And if you need any of the information I'm providing, again, send an email to webinars@tradeking.com. To move on to the next item here, passage of time. You want to put this trade on and wish the time away. Now, we can't move the time faster, but we do want it to pass almost unnoticed, if you will. But keep in mind, though, the closer you get to expiration, right? So if you're looking to put this trade on at 60 days out, the trade will cost less than if you look to put on the same trade under the same conditions at 30 days out, okay? So you need to keep that in mind. And just be aware of how the time to expiration affects the dollar amount that you're going to put into a trade.
Thank you for participating in this week's session. Please join us again next week. Get trading ideas, exchange rates, webinars, news, and commentary. Visit www.fxoptions.com. ISE FX options can be easily traded through all options-enabled brokerage accounts. These exchange-listed securities are cash-settled in U.S. dollars and have a European-style exercise.